Good afternoon, everyone, and welcome to today's webinar brought to you by Tax Connects. We are going to talk about sales tax for tech and SaaS. My name is Liz Brigson. It's great to be here as your host, and there's just a couple things I'd like to highlight as we get started today. So first of all, we really enjoy making these webinars interactive, and we'd love to hear from you and let us know where you're joining from. We'd love to give you a warm welcome. And hello to Herm, welcome back. We're glad you're here. You can download the presentation slides from the GoToWebinar control panel. And for those of you who are here to also earn CPE credits, just a couple things there. You'll want to remain logged in for at least 50 minutes and respond to 3 of the 4 polling questions. I can tell you we always use the full hour, and we usually try to set aside some time for Q&A at the end. And with these topics, the Tax Connects team is always really great about doing the lightning round to try to get as many questions answered as possible. Kim saying hello, so welcome Kim, welcome Lisa who's in Washington. So glad you're here. Love to connect with you on LinkedIn, and I would highly recommend that you follow Tax Connects on LinkedIn as well. They offer some great tips, and it's always fun to see what their team is up to. It's my pleasure to welcome back Jeff Meggs, who's a partner with Tax Connects, and Brian Greer, who's also a partner with Tax Connects. Collectively, these gentlemen have been working together for over 20 years, and they worked together previously at Thomson Reuters, and they have been building out the team at Tax Connects and just providing amazing resources for professionals who deal with sales tax and use tax as well. So Jeff and Brian, we're really thrilled to have you here. Brian, I'll go ahead and turn things over to you. You can tell us a bit more about how Tax Connect supports clients and get started into the materials today. Thanks for being here.
Yeah, thanks, Liz. That sounds perfect. And I always like to see where everyone's connecting in from. Sometimes we get some people based outside of the country, but usually get most of the states represented. Jeff and I are here in just north of Atlanta. It's, in my opinion, freezing cold today. Jeff probably likes it. We got down into the 20s, I think, last night. That's a little bit too cold for me. But anyway, just a little bit of background information on Tax Connects and myself and Jeff as well. As Liz mentioned, Jeff and I have worked together for a long time in a couple of different businesses. We've both been here together at Tax Connects for, gosh, it's probably about 16, 17 years just here, right?
14
years, that's right. I was in 2026, not 2023. But at any rate, so Tax Connects, what we do, if you're not familiar with our organization, we are a professional services company that focuses very specifically in the sales tax industry. There's a couple of different practice areas that we focus on. Jeff focuses in the consulting area of our business and really helps companies address questions related to where they have nexus, maybe where they have taxable sales tax audits, voluntary disclosures, things of that nature. We also have a compliance outsourcing service. So for those businesses that have a multi-state sales tax obligation, and they just lack the knowledge or the resources or the time to manage it internally, we become an outsourced sales tax department for those individuals. So that's a little bit about Tax Connect. That's the only commercial you're going to get from us here today. I'll flip over here to the agenda. I know some of you have probably been on these webinars with us in the past. We almost always start with some type of nexus-based discussion. Similar here today, we're going to focus initially on economic nexus. It's important as it's had a huge impact on the technology industry and those of you that are either selling SaaS solutions or maybe you have clients that are in this industry. It's certainly become a lot more challenging for them over the last 4 to 5 years, as we'll talk here as well. We'll also just review some of the taxability variances and rules from state to state, look at a few examples, and kind of wrap up with this tax citicing. You might wonder, what in the heck is that? The situsing is really just the point at which the sales tax applies. And if you've been in this technology industry, if you've been in SaaS, that's going to resonate with you, I think, very well in terms of, perhaps where do we actually charge the tax for these users that might be all over the country. So we'll talk about that a little bit too. So I think with that, we'll dive right into the first topic, which is the economic nexus piece here, Jeff.
Well, thanks, Brian. Thanks, Liz. And I think you guys may have seen a picture of me here at the beginning of this presentation, and that picture is a little bit dated now. I've got a little bit of extra cushion around me. It makes me warmer, so that's why I'm enjoying this cold weather. I'm well insulated, is the way to say it. As Brian said, it's very important to both understand the concept of nexus, but also distinguish between nexus and sales taxability. So as we've done in the past, we'll talk a little bit about nexus. It's kind of the first step in the evolution of a sales tax responsibility. Do I have nexus? And nexus really refers to a connection, a responsibility to comply with the jurisdiction's sales or use tax laws. So you can have income tax nexus, you could have payroll tax nexus, any type of excise tax that might be imposed by a state. You would first have to have nexus before that tax would apply to you. So for the majority of our history in the sales tax arena, we've operated under a physical presence test, meaning you had to have some level of physical activity or physical property located within a state for that state to impose its taxing authority on you. And that would look like an office, inventory, maybe you've got delivery trucks traveling into the state, maybe you've got sales reps visiting the state. And it was always a challenge, both from a taxpayer perspective and a state perspective, to manage to that sort of standard. And I say that because so many companies were haphazardly visiting states for purposes of trying to drive a market. States, on the other hand, were frustrated because they felt like they were having an eroded tax base due to the fact that electronic commerce had become such a big deal. And while we might question whether that's really true or not, there's probably some good validity around that. So in 2018, we had this really substantial case that was determined, and we refer to it as the Wayfair case. It really started in South Dakota. South Dakota had enacted some pretty aggressive at the time laws around sales tax nexus. Basically, they wanted to hold someone liable or responsible if they had exceeded a certain amount of revenue during a 12-month period or during a calendar year. And they set that threshold at $100,000. They also instituted sort of a corresponding threshold of 200 transactions within the same time frame. So you could either have met the nexus standard through your revenue generation into South Dakota, or you might have generated more than 200 transactions, and that in and of itself would have met that threshold. So lo and behold, this legislation is enacted. The state starts to enforce. They come to the doorstep of Wayfair. They assert they have economic nexus. They assess them. Wayfair challenges that legislation or that law. It goes up through the courts in South Dakota, actually getting to the South Dakota Supreme Court, where interestingly the courts ruled in favor of Wayfair. So now the taxpayer won, and you would think this economic nexus thing maybe goes away. But South Dakota had always planned to try to get the U.S. Supreme Court to hear this. There were a lot of states behind South Dakota trying to push them forward. There were certainly industry segments that were either supportive of the states or supportive of Wayfair, depending on kind of where their business sort of fell in the stream of commerce. Ultimately, it did go and was heard by the U.S. Supreme Court in April of 2018. And in June of 2018, the ruling came down 5-4 in favor of South Dakota. Thus, basically making it a constitutional provision or allowance that this was a reasonable and lawful legislation. And as you might imagine, the results of that were throughout the states and throughout the country responded to and reacted to quite significantly and quickly. So in June of 2018, we see that ruling, and then by the end of 2018, we have the vast majority of the states have already introduced or passed their own economic nexus standards and legislation. Now, in doing so, these states really took from that South Dakota legislation, and so most of them really look very similar. They have this $100,000 threshold. It's generally a gross receipts threshold, and then some of the states adopted the 200 transactions. Other states chose not to adopt that aspect of the legislation. And over the next couple of years, we found all of the states really coming into form, and any state that now has a sales tax has also enacted some form of an economic nexus standard. And like sales tax rules across the states, there's variables, there's differences between the states. Some of them talk about it being at gross receipts thresholds. Others might say it's a taxable sales threshold. The way we encourage our clients to think about it and to try to manage to it is to just say, where have I exceeded $100,000 in revenue over the last 12 months? And once I have exceeded that threshold, I need to really look at my business, look at the law in that particular state, and determine whether or not I truly have established economic nexus and a responsibility, therefore, to comply with the sales and use tax laws.
And Jeff, we might also highlight, you referenced some of the transaction volumes that we've started to see get repealed over the last 6 months or so, where I think the issue there was you had businesses that had 200 transactions that were $10 or $5 transactions, where those businesses were never, I think, intended to be swept up in this legislation.
Yeah, it's a great point. In fact, the namesake here, South Dakota, was one of those states that ultimately repealed that 200 transaction threshold. But I think to some degree there was clarity for a lot of people in business in that we had a bright line test. So often in the physical presence standard, these companies were having traveling sales reps visit these different states, and it was difficult to pinpoint at what point in time, how many days within a 12-month period do I need to visit a state before I have physical presence and therefore nexus. At least with this standard, it's relatively bright line and somewhat easier to interpret. But as you might expect, and kind of the reason you're here today, this had a tremendous impact on technology businesses who, for the most part, didn't have a need to be physically present or have an expansive team throughout the country. And so a lot of these technology businesses were operating in the comforts of their home state, let's say California, for example, where downloaded software and a lot of digital products and services are not taxable, not subject to sales tax. So there's this sort of momentum that's been built up over the years that our stuff's not taxable. We don't have a taxable transaction in our business model. And all of a sudden now they're thrust into this economic nexus standard, and they're now having to evaluate their tax treatment or their taxability of their products and services across all the states. And they're finding out sometimes later than they'd like that all the states aren't the same as California. So that's what we'll talk a little bit more about as we get through the presentation today.
Yeah, and Liz, I think we've got the first polling question, and after you pull that up and describe that, we'll field one of these questions here from the audience.
Okay, that sounds great. The first polling question is up on the screen, and the question is, how confident are you in your understanding of the sales tax regulations for digital goods? Very confident, somewhat confident, not very confident, not confident at all. And let's go ahead and address Melanie's question.
Yeah, so Melanie wins the the award for the first question here, so thank you for that. She asked, is the Wayfair case the one that overturned the previous decision involving Quill? And what I'll say is yes and no. It's more additive rather than overturning Quill. So it is the one, as Jeff described 4 or 5 years ago, that really set this economic nexus precedent. However, it did not circumvent, or it did not overturn the physical presence standard. So while it is clear from an economic nexus perspective that we have this bright line test that's pretty specific, how much revenue do you have in a particular state, what it's really done is added another level of complexity to a taxpayer. So we still have to look at whether a physical presence exists, but now we also have to look at an economic presence. So you could be in a scenario where you have an employee, a salesperson, doesn't have to be a salesperson, but you have an employee in a state, you only have, let's just say, $50,000 of sales into that state. They're subject to sales tax. You're below the economic nexus threshold. However, the physical presence has created nexus for you, and you still have to comply. So it's really just added another level or another layer of nexus evaluation to what we have to deal with.
Well, thank you for addressing that. We can see the results on the screen, and looks like we have just over half of the audience is very confident and somewhat confident, and then our remainder of the audience is not very confident or not very confident at all. So not quite a 50-50 split, but understandable. There's a lot here, so let's go ahead and dive into this next segment.
Yeah, so let's, the nexus piece is, again, I like to distinguish between nexus and then the taxability aspect. So nexus is a yes or no, and if it's yes, now we start evaluating what are we doing as a business, and what are we selling, or what are we delivering in the way of a service. And the term digital goods really comes to the surface quite a bit with technology businesses, and the jurisdictions have sort of adopted that term in a lot of the ways they've drafted their statutes. So digital goods, for the most part, has a good bit of similarity across the states, which should help most taxpayers. But there are a lot of scenarios, a lot of new technologies that really push the boundaries of, are they a digital good? Are they software? Are they something different that don't fit into any of those categories? But when we talk about digital goods, what we're talking about is something that's just delivered, transferred, available, used, downloaded in a digital form or an electronic form. As you can see from our list here, we threw a few examples out there: photographs, digital audio works, digital audio visual works, which can be streaming, may not be streaming. Ebooks are another category. Then we get into more of the standard things that we're a lot more familiar with, and that would be information services, and then software as a service primarily, but also downloaded software. All of the states have done a decent job, I think, of addressing their taxability or their tax treatment for sales tax purposes of these products and services. There are still a number of states that haven't really been as clear as we'd like for them to be. So it leaves some of our clients, some of the taxpayers out there with questions. And then you run into some really unique circumstances. For example, streaming in Florida, while it's not subject to sales tax, is actually subject to a communication services tax. So you might go into your analysis of your business, and you're operating, let's say, out of Illinois or California, wherever it might be, and you have reached this economic threshold in Florida, and you're just trying to ascertain whether or not your streaming service is taxable, and you find no evidence through the statutes that it is subject to sales tax, and you kind of check the box and say, well, yeah, I have nexus there, but it's really not taxable, so I probably don't need to worry about Florida. And lo and behold, 3 years later, you find out, oh, instead of the 6% or 7% sales tax in Florida. It's really subject to the 11 to 13%, depending on the local jurisdiction, communication services tax. So it can be a kick in the teeth in that regard. But in essence, what Brian and I have probably found ourselves challenged with more often than not is, as I was talking about earlier, defining what our client is really providing. Does it fit into one of these sort of nice and neat definitions or product types, or is it something unique? And ever more companies are designing and developing unique service elements and tools around these software applications that really make them quite interesting, but also complex. And it's been a lot of fun. We get to see and hear about a lot of new things. Sometimes we've probably experienced a service or an element of one of our taxpayers' business model, and we really didn't even understand what it was they were doing until we got into the inner workings and really peeled the onion back. But suffice it to say is, if you're in these categories, or you feel like you're close to being in these categories, and as I said before, Nexus is that first question, yes or no, you probably need to just start thinking about whether or not there's an applicability of sales tax. Not all of the states tax all of these services. In fact, quite a number don't, as we'll talk about in the next slide. When we talk about technology taxability, again, we're going to focus on what we feel like are the primary categories that we tend to deal with, at least, those being information services, software downloaded or delivered electronically, and then software as a service. So we wanted to just illustrate for you kind of some of the standards that are out there in this regard. And as we looked at the economic nexus map, there are 5 states that don't have a state-level sales tax, those being Delaware, New Hampshire, Montana, and Oregon, and lastly, Alaska. And I left Alaska last, even though it's first in the alphabet purposely. Alaska does have local city-level home rule sales taxes, so there is a reason to be a little bit familiar with Alaska. And in fact, Alaska does have an economic nexus standard for those city locations. So you can almost treat Alaska like a taxable state in that regard. But there are about 13 or so states that tax what we would define as an information service. This would be a subscription to something like maybe it's a stock service, anything that's compiling information that's otherwise generally available to the public and then providing it in a routine fashion tends to fit into that information service category. Software delivered electronically, more and more states are taxing this area. If you go back about 10 years, there were probably 25 states that tax downloaded software. Now there's 34 states or so that tax downloaded software. And when I quote these numbers, these states, keep in mind that these are just some general observations. There are a lot of unique circumstances in states. I say a lot. There are a few circumstances in some of these states where you might generally say downloaded software is taxable, but for an exception. For example, in New Jersey, business enterprise use of downloaded software is exempt, but consumers' use, if I personally subscribe to a downloaded software package, it's taxable to me. So there's some unique rules along those lines. There's also some unique tax rates in certain states. Texas actually exempts 20% of the total charge of a SaaS product. Connecticut taxes SaaS at a 1% rate. So there's less states that tax SaaS than downloaded software at around 19 or so. But again, there's some special rules within that category of states as well. So it's important to kind of just know what you need to know. And sometimes that's pretty straightforward and easy, depending on what your product is. Sometimes it can be a little bit challenging. Another problem that we find with technology businesses and technology products and services is bundling. A lot of companies are doing some level of bundling of their services. Most of us are familiar with bundled services from the early cellular telephone days, where you would get a bundle of data, and you still do, bundle of data and voice and and sometimes the phone was part of that bundle itself. So that creates a little bit of complexity around taxability. You get into true object tests or predominant use tests, which some states respect and other states don't. So it's just another sort of category or area to be aware of. We kind of illustrate for you here the difference between SaaS and information service. And the reason we kind of isolate or identify this separately on the slide is it is the area that we find clients somewhat perplexed as to whether they fit into one or the other. They might feel like they're providing an information service, but in reality, it's a SaaS product. And what I like to communicate when I talk to clients around this is I'm not a technology person, first and foremost. I'm a sales tax geek. So we try our best to try to understand the technology side. But when you're leveraging the computing capacity or the computing capabilities of a software application in a remote capacity, that's where we would define you as a SaaS product, where the information is simply being compiled and gathered from outside sources and presented to you or pushed to you from the vendor. That's when it's more like an information service. But there are a ton of businesses that we talk to and see that their products and services overlap both of those, or they have elements of both. And it just takes some interpretation. Sometimes you end up just having to make a determination, go with your gut, have a basis for that determination, and leverage or utilize some of the language in either the statutes or some cases or rulings where the states maybe looked at something or a business similar to yours and already ruled on that.
Jeff, we also see scenarios where sometimes clients will look at or consider the way something is billed and see if that or think that contributes to what the product is. And as an example, we'll see people or hear people describe that this is a monthly subscription or it's an annual subscription to this software product. And so they immediately go towards like a SaaS model because SaaS historically gets billed as a subscription model, whether it's monthly or annual. But when you kind of peel it back and really start to understand what they do, we might find out that it's electronically delivered software. It just happens to be billed on a monthly basis rather than a upfront license fee. So again, just kind of understanding what it is that is actually being purchased, not necessarily how it's billed, doesn't necessarily affect the taxability of what it is. So Liz, I think we've got another poll question, and then I think we've got another couple of questions here from the audience.
That sounds good. The polling question is up on the screen. How is your business currently managing compliance? This just gives you an opportunity to reflect if you are not doing this and possibly need help. Maybe you are using technology with an internal person, perhaps only technology, perhaps all internal, maybe outsourced. So if you want to go ahead and respond to this polling question, and we'll dive into some Q&A.
Yeah, so Jeff, this one's from Kevin, and this is going to be a little bit of a rewind back into the Nexus discussion. So does having an employee in a state trigger physical Nexus and sales tax reporting requirements, even if there are no sales made in the state?
Short answer is no. You're right to think you have Nexus for sales tax purposes, but the second part of that equation would be whether or not you have taxable sales. So in your situation, it sounds like there's no sales, which would make that a pretty easy determination. A lot of companies, though, struggle with that because they have sales, and their sales may fall into one or two categories. It could be that they're selling to exempt entities like school systems or not-for-profits. And when I say that, I don't mean to insinuate that school systems and not-for-profits are exempt in every state from sales tax, because they're not. But in a lot of states, that does qualify as an exempt status. So a company may look at that and say, okay, I've got Nexus, I've got some sales, but all of my customers are exempt. They've all issued exemption certificates qualifying as as exempt. What do I do next? Well, the answer clinically, statutorily, is that some states would still want you to be registered for sales tax purposes, and you would report gross receipts on a periodic basis on those sales and use tax returns, but you'd never have any tax to report, never have any tax to pay. I don't always believe in sort of following those rules, but there can be some advantages to getting registered and filing those zero due returns. So sometimes it doesn't sound very logical to do that, and in other cases it might be a good idea. Usually it's a good idea when you've got some products or services that maybe you've got a little bit of question as to whether they're truly taxable or exempt, or maybe you're not so sure you're ever going to keep a pretty good system in place to keep up with your exemption certificates. So you kind of want to file to get a statute of limitations running in your favor. If you're filing regularly and timely, and even if you're reporting zero due, you get the advantage of the statute of limitations such that 5, 6, 7 years down the road, the state comes in and says, oh, you should have been charging tax all along. Well, the state can only go back maybe 36 to 48 months because you've been registered and filing. You're not registered and filing, they can go back as far as they would like. They typically go back 7 to 10 years. The other scenario would be you're in a business that the products and services, or let's not even call them products, let's just call them services that you're providing fall into what we call an excluded from tax category. Those would be things like legal services, accounting services, architectural or engineering services. Those services are not represented as taxable in the statutes at all in most states. Not all states, but most states. And so if you're in that business where your products and services are excluded from sales tax, meaning there's no mention of them in the statutes, and there's no need for a customer who buys them to issue an exemption certificate, you would not need to register for sales tax purposes in those scenarios, even though you had nexus.
Yeah, hopefully that clarified the question. And Liz, I'm going to hit one more thing here before you pull up the results. So just for clarification, Brent is asking, did we state that digital goods sales are subject to the Florida CST?
I did not state that, just to be clear. And I'm not going to say that with a great deal of confidence that I'm going to be clear enough to tell you whether or not it's taxable. I can tell you downloaded software is not taxable in Florida, streaming services, and I just happen to have had to deal with this with a few different clients on the streaming side. So we've had to go down the path of letter rulings, and it's been a challenge from time to time. So I would probably have to get back to you just to confirm that digital goods would or would not be. I would say initially no. I would not expect them to be.
I think we may have said the streaming services are subject to the CST.
CST, right. But I don't believe the digital are subject to sales tax or the CST. But please don't quote me on that.
All right.
The results to the polling question are up on the screen, and it looks like internal is the most popular answer, followed by technology with the help of an internal person. So thanks everyone for responding, and we'll close the polling question and send it back to the slides.
So some of this next slide probably is going to have a little bit of overlap to some things I've said earlier, so I'll try not to be too repetitive, but the nuances of digital goods. And again, when we talk about digital goods, we're talking about all aspects, meaning software downloaded, SaaS, as well as what we'd see as digital audio works or digital video audio works. Nexus implications. And this is going to overlap a little bit with one of our discussions we'll have on the last slide related to situsing. Because when you're dealing with things that are downloaded, things that are delivered electronically, it's not necessarily true that you're going to have a ship-to address on your invoice. And when we deal in sales and use tax, generally speaking, when we're situsing the sales tax applicability, it's based on where title transfers, which is usually driven by ship-to location. We're typically looking at a FOB shipping point or FOB destination shipping methodology. And so in those cases, title and possessions tend to transfer at the destination or the customer's location. What happens when we deal with digital goods, particularly in the software arena, SaaS, and to some degree downloaded software, is you might be selling to large businesses or even small businesses that have employees who are spread out across the country. And as a result, you have potential revenue generation and potential siting in states that you otherwise didn't realize as a vendor you had. Because you might be licensing or subscribing, selling subscriptions for 1,000 seats for a SaaS product, and it might be $1 million license fee. That gets potentially spread out over a number of states depending on that customer and how they use it. I'm going to get into how to manage through that in our last slide today, but I only visit it here to just tell you it can get a little complicated. I'm also going to encourage you later on to not let it get too complicated. Try to manage yourself and minimize the complications in that regard. But it does create issues, and there are implications to selling and delivering electronically. Then we talked about some exceptions. I'd already covered Connecticut, which applies a 1% rate to SaaS rather than their standard 6.35% sales tax rate. Illinois is an interesting state. It's got a couple little nuances. First of all, downloaded software. Tax applies to the sale of downloaded software, except they have some exceptions. And there's 5 criteria that if you meet these 5 criteria, your downloaded software is actually exempt. Some of those, I'm not going to quote all 5 criteria, but I will tell you that usually it's required that there be a physical signature on the contract. That's the weirdness of some of these rules. But there has to be no ability to resell the product or the downloaded software. You must destroy the copies of it at the point in time when the license expires. There's just a few nuances. They're pretty easy to qualify for. So if you're just aware of them, whether you're a vendor or a customer, you can probably save some money in that regard. The second one, which has probably been a little more detrimental to a lot of companies we talk to, is the city of Chicago has some unique rules in and of themselves. They're what we call a home rule jurisdiction, but they're not like most home rule jurisdictions. And when I say home rule jurisdiction, if you're not familiar with that term, what I'm really referring to is in some states, the cities are allowed to establish their own sales tax laws and their own sales tax administration. We see this in Colorado. We see it with the Louisiana parishes. We see it with a number of cities and counties in Alabama. Each of those states is different in the way it works, but those states have these cities or counties, in some cases, that they'll have their own administration and they'll actually have different, in some cases, taxability rules. Well, this is true in Chicago. Chicago is the only city in Illinois that does this. And what's interesting about Chicago is their sales tax is actually administered at the state level. But what they've done is where the state exempts SaaS, for example, the city of Chicago taxes SaaS, and currently that rate is 9%. So you're going about your business, you're trying to do the right things, you've done your due diligence, you've understood the economic nexus standards, and then you start to do this state level research for taxability in Illinois, and you find out SaaS is exempt, and that's your primary deliverable. So you just go about your business, you don't register, you don't do anything. Then Chicago comes knocking on the door. And why would they come knocking on the door? Maybe they were in one of your customers' businesses auditing them, and they saw your invoice. And the invoice was meaningful enough or material enough that they chose to make an inquiry. And so all of a sudden you get this notice, you get a call, some level of inquisition about what is your business in Chicago. And they can quickly uncover that you've got nexus and you've got a responsibility to comply with that SaaS rule. They have their own economic nexus standards. This is true in all of these states that I described, the Colorados, the Louisianas, the Alabamas. The cities that are home rule have established their own legislation such that they can impose their taxing authority at the same time you've established economic nexus at the state level. So it's a little tricky. Thankfully, there aren't a lot of states that are like this, but Chicago being sort of a big city where there's a lot of SaaS usage, you can quickly find yourself underwater. I talked about New Jersey earlier, a little bit of a nuance there with downloaded software. South Carolina is one that is kind of backwards, and what I mean by that is South Carolina doesn't tax downloaded software, but it does tax SaaS, which is different. No other state does that. There are certainly a number of states that tax downloaded software and exempt SaaS. There are certainly states that tax downloaded software and tax SaaS, but no other state exempts downloaded software but taxes SaaS. So that's what makes South Carolina a little bit of a unique. And then Texas, I talked about earlier, applies this 20%, we'll call it a discount. It's an exemption at both the state and local level for the delivery of SaaS.
So Jeff, you mentioned Colorado there, just to kind of drill down on that a little bit. And Joel asked a question about, would Nexus in Colorado at the state level also create Nexus in all of the home rule cities? And does that matter if you're talking about a physical presence versus a economic presence?
Good question. And the first answer is economic nexus at the state level is going to trigger economic nexus at all the home rules. The second part of that question, if I have physical presence in Colorado, does that give me nexus in all the home rules? No. It only gives you nexus in the home rules in which you have physical presence or physical nexus. So yeah, it's a little tricky. The other thing that makes this even more fun to talk about is in Colorado, these home rules. There's about 73 home rules in Colorado. Denver is one example, as you might expect. A lot of the larger metropolitan areas. But what's interesting is Colorado doesn't tax either downloaded software or SaaS, but the cities, these home rule cities, they do tend to tax downloaded software and SaaS. Not all of them do, and I'm not projecting that they all do, but a good number of them at least do. And the rates in Colorado are kind of weird because it's pretty evenly split. If you've got let's say a 9% total rate in Colorado, probably 4% of that is state and 5% of it is local. The local rates in Colorado are pretty heavy. So if you do have a SaaS business in Colorado, it's a worthwhile exercise to check your business activities and make sure you're not getting stuck with some home rule taxes. The good thing about the home rule cities in Colorado, while they are fairly sophisticated and some are more so than others, they're not necessarily well staffed as compared to the states. So they have a little bit of a limitation as compared to the states to reach out and touch you. The natural evolution when we start talking about digital goods, and again, this probably has more of a feel when we're talking about software, but there's ancillary or vertical services that are associated with these products. And what we're talking about here is, again, focused primarily in the software area. You may be just in a position where you're consulting initially with a company to figure out which software package they really need. And it might be a software package you sell or resell. It might be a package that they have to buy from another third party. There are a few states where just that mere consultation, and if it's associated with an ultimate sale of software from me, that consultation aspect becomes taxable. So just something to think about. It's not prevalent, but it is available in some states. And then we get a little bit more engaged with installation, and we kind of put installation, configuration, and implementation together. They kind of all mean the same thing, although there are differences. But what we're talking about here is I'm in conjunction with the sale or the licensing or the subscription of a software package. If that software is taxable, there's a possibility that the associated installation or configuration or implementation might also be taxable. It's not always the case that it is, but it definitely could be. Now, on the flip side, it's rare, if not, I don't believe it ever happens, that I sell software that's exempt, and in association with that sale of exempt software, I provide installation, implementation, and configuration. In that scenario, the implementation and installation and configuration is rarely, if ever, taxable, because the primary product and sale is is a tax-exempt software package. Hopefully that I didn't confuse you and that made some sense. Going down the list here, customization. Historically, if you go back 15, 20 years ago, it was not uncommon for the state statutes, or at least the administrative policy of states, to afford a fairly easy way to change packaged or pre-written software into custom software. And why does that matter? Because generally custom software is not subject to sales tax. So it was the case in North Carolina at least 25, 30 years ago, where if you sold software that was otherwise pre-written and packaged, even delivered on a CD or a floppy disk back then, and you did ever so slightly customize it, and maybe that customization was to just add some code such that when I turn the computer on, it says, "Hello, Jeff, how was your day?" That in and of itself was customization, and that could change the tax treatment from taxable to exempt for that entire software package. Well, the states ultimately wised up to that, and you really don't find that opportunity to exist anywhere anymore, to my knowledge. But what still does exist is if it's truly customized, meaning you're writing that program essentially from scratch for that customer, that tends to be exempt software in most states. Not all, but most. And to the extent you sell pre-written, pre-packaged software, but you then have a separate charge, and it's a reasonable charge, for some level of customization, the states will usually afford you exempt treatment for that separate customization charge. But the primary pre-written package is still taxable. Again, we're only talking about states that do tax downloaded software or do tax SaaS. And then finally, there's usually some element of maintenance, more so with downloaded software than we might see with SaaS. We might see some support services with SaaS, but generally it's with downloaded software that we deal with updates and fixes and troubleshooting and training and support. A lot of times it's bundled, and it's meaningful and important to know whether or not it's a mandatory maintenance package or an optional maintenance package. And I won't go through the drill of doing what I did with the installation and customization piece, but just suffice it to say that it's important to know the tax treatment of maintenance agreements, whether it's SaaS or downloaded software. It's important to know whether it's mandatory or optional. There are different states and different tax treatments depending on those answers.
So Liz, I think we've got another polling question here, and then there's a ton of questions in here that are going to be hit on this last slide about situsing and benefit of use and where do we charge sales tax on a SaaS solution.
Well, let's go ahead and get that third polling question addressed. So the question's up on the screen. What is the most common misconception or misunderstanding about the taxability of SaaS that you have come across? So for the audience, this is something that is just really your opinion. We're interested to hear from you. So perhaps a misconception is that SaaS is always exempt from taxation, or maybe that the tax treatment is the same globally. Maybe that only the service fee is taxable, not the subscription cost. Another could be SaaS tax regulations are consistent across industries, or last, that SaaS is always subject to value-added tax or GST. So what is the most common misconception or misunderstanding that you have come across? We'll leave this open for just about 5 or 10 more seconds to get some more responses. And then we'll close
while
it
you've
down.
got that open, I'll just hit on one of these questions here, Liz, that looks like Lindsay asked. And I'm sure some of the audience is familiar with the load and leave concept related to software installation. So the question is it considered load and leave even if the installation of the software is done remotely by a tech accessing our servers and pushing down the software?
I'm not going to say I'm overly confident in this answer, but I'm going to say that generally that would not fall into the category of load and leave. Load and leave generally and historically has been where there is a tangible medium upon which the software has been loaded initially by the vendor, and then it's brought to the physical location of the customer and physically using that tangible medium loaded into their enterprise servers. That's my perspective of load and leave. It's a good question. I wish I don't deal with that question enough.
The way it's phrased, it makes me sound like, or makes me think about electronically downloaded software is what it sounds like, where it's electronically pushed down.
Yeah,
if that tech person is
that's electronically downloaded. Yeah, I think if a tech person is loading it remotely, that we would call that an electronically downloaded software.
And certainly, Lindsay, we're happy to talk with you afterwards and get more clarity on that for you.
Very good. I closed the poll down, and you can see that SaaS is always an exemption from taxation. That is a common misconception. That's the most common one. So thank you, everyone, for submitting your responses.
All right, here's the finale that everyone's been waiting for, Jeff.
All right, I don't think it's going to have the same effect as the finale of the July 4th fireworks, but we'll get through it here in a few minutes. I kind of already hit on this topic. Typically, when we're talking about the sale of tangible personal property, you're going to see an invoice that's got a bill to and also a separate ship to address, and almost always, 95% of the time, it's that ship to address that defines the situs for sales tax purposes. So as Brian said earlier, the situsing rules and the sales tax situs itself is really the answer to the question, where is it taxable and at what rate? And you have to know the geographic location of where title is deemed to have transferred to be able to answer that question. So historically, we're talking about tangible personal property. Usually we're talking about a shipment that is destination based, meaning the vendor has arranged for shipment and has risk of loss during transit, such that the customer only takes possession and ownership and title when it lands at their doorstep or on their loading dock. So that's sort of the standard we start with. And then we start getting into this whole digital world, this whole electronic delivery, transfer, and as we've talked, everybody here knows, we're using our computers all the time, everywhere, even while we're traveling. So we're actually leveraging some of these products and services in different places, sometimes in the same day. So there does start to become some challenges, and there are some states that have some really kind of unique rules. Florida, for example, doesn't tax SaaS, but be careful, because if you do have a server, if you're the vendor and your server is located in Florida, and your customer is accessing that server for purposes of executing or leveraging the computing power, what Florida is really saying is that customer is leasing tangible personal property within the state, and it becomes a taxable event. So you want to be aware and knowledgeable about some of those nuances. I think Utah has something similar, although Utah definitely taxes SaaS and download software, but they have some unique rules about servers in Utah. I have it in the back of my mind. It might be just because I'm working with a client right now who's just gotten dinged by the Utah Department of Revenue on this. So location of server can be a factor. We've talked with companies who are storing data on servers, and whether or not that storage of data might create nexus, and they're leveraging AWS platforms. And so they're out there loading in like an infrastructure as a service or a platform as a service type model. They're loading or downloading software into an AWS platform or environment. And most of the time, my clients seem to know where that server is located, but I don't know that that's always the case. So again, it creates complexity. That's the message, and it just means you probably want to just take a look at it and make sure you don't get exposed as a result. But these next couple is where I believe the rubber meets the road in terms of the firework display and the finale that Brian was describing. Let's just say we're a vendor that sells SaaS subscriptions, and we sell them in multiple seat license fashion. So, customer might be in New York City, they buy 1,000 seats and a 2-year subscription, however they pay for it or over time or initially, it doesn't really matter. But New York taxes SaaS. And so it becomes a challenge when that particular company has locations all over the country. They've just happened to be headquartered in New York, a state that does tax SaaS, but lo and behold, 50% of their employees are operating using these seat licenses in states that don't tax SaaS. What do? The converse can happen. I can be selling 1,000 seat licenses to a customer in Oregon, which doesn't have a state sales tax, and that customer does the same thing. They have 1,000 users spread out all over the country. A number of those users are in states that do tax SaaS. What do? It's a difficult question and a difficult answer. And the reason it is because the way the states apply their citing rules for SaaS is they use the term benefit of use. Where is the customer's benefit of use? If the primary benefit of use is always going to be at headquarters, then they're going to look to tax that particular location, that address. If the benefit of use is literally spread across those 1,000 employees fairly evenly, now you've got a really challenging tax scenario. Now, the advantage the states have in this regard is when they come in and look at something, they only have to be concerned with their state. So New York comes in to look at this invoice and they see these 1,000 users, they see the bill to New York, they're just going to assume it's all taxable in New York unless proven otherwise. And so it becomes incumbent upon the customer or the vendor to show evidence that those users are, or the benefit of use is elsewhere.
Jeff, let's take a quick pause here. And Liz, I know we're kind of getting towards the end. If you want to throw up the last polling question, just so everyone at least has a chance to answer that. And then we can continue the discussion here that Jeff started.
Okay, that sounds great. Thank you so much. So the final and fourth polling question is up on your screen. Are you interested in learning more about Tax Connects? So if you'd like someone to reach out to you, please go ahead and let us know, and you can respond to that polling question. Gentlemen, if you don't mind, since we only have a couple minutes, I'll also just do the close for anyone who needs to leave at the 4:30 Eastern mark, the scheduled end time. We want to say thank you so much for joining us, and we hope that you'll keep a lookout for Tax Connects webinars in the new year, and you'll be able to access the recording from your Corsa dashboard and your CPE certificate. And of course, we'd love your feedback. That poll, or rather the survey, will pop up when you take the, when you close the GoToWebinar control panel. The course survey will pop up on your screen, and we would love your feedback. With that said, for anyone who has a question, if you would like to spend extra time with us and hang on the line, I'm happy to leave the line open. And Jeff and Brian, what I'm hearing from you is you're happy to take questions. So with that, I will turn things back over to Jeff and Brian. And thanks for being willing to always entertain audience questions.
Yeah, before we try to take a question, I'll try to wrap up this last piece. The reality in the tax technology world, and particularly as it relates to applying tax to invoices, is that vendors who are selling 1,000 seat licenses to a New York customer aren't going to be capable of breaking that invoice out 1,000 ways to charge sales tax based on wherever those users are located. So what we typically will advise clients is, look, go the simplest route, bill that client, and in some cases, what those companies can do that are getting billed all of that tax is they can present you with what's called a multiple points of use exemption. In some states, this is a formal exemption certificate. In other states, it's more of a sort of casual information. And they send you an email and say, our users are 40% in New York and 60% outside of New York. So they're not going to, you don't want to know where all the customers are because you don't want the obligation that the state might put on you to charge each of those different locations. You just want to know how much is in New York and how much isn't. And you want the customer to then adopt or assume that responsibility. A couple of the states that do have these multiple points of use exemptions are, like Washington has a specific form. I think there's a few other states. Texas has specific guidance in their statutes for that, and you can use their general exemption certificate to accomplish it. When you issue a multiple points of exemption certificate to a vendor, The vendor is relieved of charging any tax on that transaction, and the customer then takes the responsibility to accrue and remit tax directly to the jurisdictions, including their primary headquarters state.
Yeah, and Jeff, I think we'll just go ahead and wrap there. I just wanted to make sure that you touched on that, kind of finish your thought on that, on this last piece here regarding the cytosing and how we want to bill a SaaS-based client. So thanks for going through that with everyone. I know we do have a few additional questions here, but we are against time here, so we'll certainly follow up with any open questions. If you want us to, we'll reach back out to you and address those one-on-one. So thank you, everyone, for your time. We appreciate it.
Thank you, everybody.
Thank you so much. We'll talk to you soon.